Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's streamrg.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Next up on our event schedule is the Planet MicroCap Showcase Virtual on December 6th through 8th, 2022. On day one of the event, we'll be hosting the first ever Stock Pitch World Cup, 6 global areas, 6 moderators, 24 total stock pitches. Joining us to moderate each special session is Maj Soueidan, representing the USA, Paul Andriola representing Canada, Fadi Diab representing Australia, Jason Hirschman representing Europe, and Kelvin Sito representing Asia. The only way to see the Stock Pitch World Cup is by registering now. And then on day 2 and 3 will be presentations from microcap management teams as well as one-on-one meetings. Attendance for both events are complimentary for investors. This is both a virtual and our upcoming event in Vegas, which is April 25 through 27, 2023. Registration is now open for our virtual event. So to join us, please visit www.planetmicrocapshowcase.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Andrew Martin and Nick Peters, CEO and CIO of Fairlight Capital LLC. Fairlight Capital LLC is an alternative investment manager with exposure to small and microcap stocks that I've actually been following for a while, and this is long overdue to have both Andrew and Nick on the show. They recently published their Q3 2022 investor letter, so I wanted to dive into a bunch of topics that they brought up in there. The value they found in U.S. community banks, the LDI Pension Crisis, outlook for the remainder of 2022, plus their investing strategy and research process, where we talk about their investment in RCI Hospitality. Thank you again for tuning in to episode 247 of the Planet MicroCap Podcast, and please enjoy my conversation with Andrew Martin and Nick Peters. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's streamrg.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's streamrg.co/PMC. Gentlemen, thank you for joining me today. How are you doing?
Good. Thanks for having us, Robert. Definitely enjoy this.
Yeah, it's awesome to have you guys on here. Look, I've been following you guys for a while. You know, I love that you have on your website, you're an alternative investment company, but come on, man, you got microcap exposure. That's just another way of saying it, right? I mean, come on now. But in all seriousness, you know, I really appreciate all the work that you guys do out there, and I'm excited to have you on. So,
yeah, we put that up there. We don't do strictly microcaps, but I would say that's like 80-90% of where we tend to fall into our microcaps. Once in a while, something a little bit more liquid catches our eyes, but yeah, we specialize in the smaller, the better. The more liquid, the better.
That's great. Hey, same here, man. Let's get weird then. So let's start off with where this passion begins. So, I mean, Nick, you kind of got to start it off there. So where did your passion for microcap investing begin?
Believe it or not, the first investment book I read was in Iraq. It was The Intelligent Investor. Fellow man in my squad, he had it. I mean, nothing to do. He had that book sitting there. So it's like, hey, let me read this. And that was right before I went back to university. And while there, I was an econ major, and that book kind of stuck with me. So I kind of went into the finance track after that. Then did grad school in finance. And during that year, kind of got the Warren Buffett bug, which I think, a lot of people have had. And probably learned, I would say, more or just as much of investing from reading books on Warren Buffett as maybe I did in the finance classes. At least more that ended up I put into practice. So yeah, I mean, that kind of stuck with me. Became, read, obviously, like everybody, read Snowball, read other books on Buffett, and read The Intelligent Investor, and then kind of went into the microcap space after that. That's where, the highest returns, historically have been shown to be. So that was it, read all of Warren's, the Buffett partnership letters, and talking about him, and then, the crazy returns he generated when he was a younger man and dabbling in this area. So said, I want to see if I could do it, see if we could do it there, and see if that a possibility still existed, which it's still, I mean, I think it still does. I hear a lot of people, either on Twitter or other podcasts say, Warren, he had it so good, no competition, etc. Yeah, I mean, he had different advantages, but I think today, microcap investors, we have other advantages that he didn't have. So you got to take the good with the bad. And I do know, and I mean, it's not just us, there are other fellow microcap investors who do very well. And you got to adapt to the times. He had the ability, he had to go plow through old dusty basements sometimes to find financial statements, get pieces of paper. I mean, the information was harder to come by. But today, I mean, information is a little bit easier to come by, but sometimes, I know there's stocks where there's probably two people reading the footnotes, and I probably know who those two people are. For sure. They're not clicking that extra link to go and, do it. I don't know why it doesn't happen, but, that stuff still exists. I mean, so it's still there. And I think it can still, great returns can be had in the microcap space. I just love doing it. Everything about it, I love, there's a little bit of a rush when you find that thing and you're like, holy crap, this really exists. Yeah, it does. And then you get to go buy it. And you meet great people in this space. I mean, that's one thing I'll say. Some of, my best friends I met, through Twitter and microcap investing. It's a much different world today. And it's generally a great community to be a part of. You learn a lot. It's more, I think you receive more than you give, I feel like, with this community. You kind of always feel like you want to keep your secret's a secret, but, the main secret is if you're passionate about it or not. If you're passionate about it, you'll do well. And, helping other people out, they usually pay it back to you.
100%. Yeah, no, that's a great place, right? Everything you just said, I couldn't agree with more. And by the way, Nick, thank you for your service, man. Really, that's awesome. I didn't know you were a veteran, so that's really cool.
Yeah.
So Andrew, absolutely. So Andrew, same question. Where did your passion for microcap investing begin? Similar path. Read the books. We're like, oh, I bet maybe I'll go downstream and see where the other greats made their killing.
Yeah, a little bit like that. Yeah, I guess I started off at the very beginning in a different place. I did a PhD in astrophysics, which doesn't really directly relate to any of this stuff, but I guess it gives you the analytics and the numerical side of things. But yeah, similarly, I read Benjamin Graham, Warren Buffett, and I think it was Bill Ackman who said that you're either struck by an epiphany moment or you're not. When you read those, you realize this makes sense. This is how you should be investing, looking at the value of companies. It just all makes sense. And so, yeah, I kind of went down, a parallel path, I guess, to Nick. And then, I set up Fairlight a few years ago, and I brought, Nick on board and met him. He was working as an analyst at first. And then we set up the Fairlight Alpha Fund in March. So Nick had built up this really great track record, using, it's not just value, I guess, is one part to point out that we'll talk about it a bit more sort of through this, that it's more of an extension of that Buffett himself and other value investors have kind of extended to become more GARP, growth at a reasonable price kind of investors, where you want to be greedy and get the value, the growth and the quality elements of the business, so that you've got a growing business that's good value, as well as having quality elements, and it may have a unique product, the business that you're looking at, or it may have a network effect, those kinds of things. So yeah, and so we started the fund, and we've been going for like 3.5 years now. So yeah, it's just kind of grown from there. We've kind of been growing organically, like Nick says, reaching out to people in the community from the investing side, and then looking to investors and building it organically as we've gone along. So yeah, and that brings us to today, I guess.
Very good. Yeah, no, look, we have a lot to cover today because you guys actually just came out with this is going to be, we're recording this on Tuesday, the 18th. This is going to be coming out on the 20th of October. And you guys just came out with your Q3 2022 letter. So we got a lot to cover even before we get to that. But, from there, let's dig into the nitty gritty, talking about the Fairlight's investment process and your philosophy. So Andrew, coming right back to you, can you give us that overview of the philosophy for the firm, and then your process for potentially finding new quality investments? Ideally quality investments, of course.
That's what we aim for. Yeah, I'll give you the high level view, and then Nick's very good. He'll be able to dive into the details of the process. But yeah, it's kind of, as I was saying, it's we look for stocks that kind of have all of those elements of quality, growth, and value. And you basically want all of those things at the same time. So, looking at various metrics of value. So whether it's free cash flow multiples or PE multiples, looking at stocks that are cheap on that basis. And again, looking in industries, we're kind of sector and geography agnostic. So we kind of try to be nimble. And we started off looking in the United States in 2019, and that became more expensive. So we ended up going more towards Southeast Asia. And now that's started to reverse. We're partway through that process. We don't know how far through that process we are, but the US has become cheaper. So we're starting to find some better ideas again in the United States as well. But yeah, then combining that with a lot of research that Nick does in terms of diving into the companies themselves, what their business lines are like, what drives their growth and their earnings, and what is their kind of their kind of competitive landscape. Do they have like a unique position, or are they uniquely positioned in some way, or have some kind of network effect that gives you the reason why their growth and their earnings are performing so well. And I guess one way to sort of look at it is to look at some of the case studies, some of the examples of this kind of stock that we found. So I guess myself and Nick, we often talk about, what does an ideal investment look like for us? And often in the US, you find stocks that, maybe the price is below $1, they're a low market cap. So yeah, a microcap or, smaller. And we're kind of pushing the liquidity envelope of what we do. We try and manage that on the investor side as well. And again, a company that's got good growth, healthy balance sheet, and then, these kind of network effects where it's going to be difficult to compete with them. That's kind of, we try and just get all of those things in one go. And and then let the thesis play out, really.
Very good. Nick?
Yeah. I think for us, it's kind of, I think one of our, what we do differently is we literally go through, when we go to a market, we go from stock A through Z. Typically sort them a little bit differently than that, but we cover every one. And, we've done that now in certain markets several times. So we can do it a little bit more efficiently. Like I know, for instance, the first time I went through all the stocks on the OTC market, literally every single one. And this was back when you had a lot of non-reporting and I mean, it took, I mean, I don't even know how many months or whatever. I mean, there's a lot of Saturdays, a lot of just got time, go in there, go through them. And you go through that. It's kind of an iterative process. You go through, you get a list of like 500, then you go down, you go through it again, and you go through it again. And, it really never ends. It's, that's where I say, like, I mean, either you're passionate about it or you're not. I mean, if you're not passionate about it, it's going to be like worse than watching paint dry. It just, I don't know, for whatever reason, some people like looking at the financial statements, like clicking through different companies, different websites. I mean, trying to put the story together. And what's interesting, I think, about like microcaps is often there is no, that story's not there. Like, I mean, say you're going to invest in Apple. I mean, you can go get an analyst report. You can probably find some real in-depth blog, and the story can be put together for you. If you're investing in a company with a $20 million market cap, you're lucky if you find a blog, and that blog might be just, it's some summary statistics. So you got to go do all the work and put it together, which, either I guess you like that or you don't, because you run into a lot of dead ends, but you find some very interesting things too. So, I think that's what makes microcap so interesting is, it's challenging, and all the horror stories you hear about microcaps, they're all true. Like, I mean, I guess there's got to be sharks in the water to keep the swimmers out. So it can be dangerous. It can be frustrating. It can be all those things, but, and liquidity is a huge, factor you got to deal with. But it's, if you enjoy those challenges, it's just a never ending sea of challenges.
So Nick, when you're digging through and doing all this research and trying to figure out, like, okay, which rabbit hole do I want to go down? What are some of the things that stand out to you when you're going through some of the financial statements, you're putting the story together? What sticks out to you?
There's no real, I guess, one thing. What I think is when you do it a lot, you kind of get a pattern recognition of, like, sometimes it's really weird. You'll find, like, this is really interesting. Like, usually, I'm always looking for, valuation metrics, whether, price to book, price to cash flow, price to earnings. Like I always say, like, I mean, give me, the income statement, balance sheet, and cash flow statement and the price, and, give me like a minute to decide. I mean, it's just when you do a lot of stocks, that's what you're doing. You just keep constantly getting these pitches, and you look at it and you pass. And, sometimes you'll scroll through looking for a quick footnote. And sometimes you find a quick footnote or you don't. But yeah, I mean, you're kind of just looking at that. I mean, okay, so you look at the balance sheet, they have a lot of debt, they're losing money. All right, I'm not interested unless maybe they got this asset that is there somehow. And sometimes you find it in a footnote, sometimes you find it on the balance sheet. A skill for a microcap investor is the ability to, Warren Buffett has the idea of too hard pile, to move through that efficiently, which is like, I mean, this is interesting. But you can waste, a day going down a rabbit hole you shouldn't go down. I mean, that happens. So, I mean, whatever, don't cry about it. But you do it too much time, you waste time. So, I mean, being able to discern, is this interesting or is it not interesting? Look at that. I mean, I can calculate roughly in my head, what's the return on tangible assets, or what's the return on tangible equity, growth, you look for those things. And usually, I mean, like, you don't need to be exact. I mean, if return on tangible equity is 15% and you estimate at 20, like, not until you get into the deep dive do you need to know that. Your growth, I like looking at long trajectories. So I'll pull up, usually, in the filing, you'll get 2 years, but you can look. Ticker is a great tool. You look through over a longer period, which sometimes works, sometimes doesn't. But yeah, I mean, a lot of times too, like, you look for changes. That is in the microcap space very common. There's, and it's not going to be advertised because there's not, like, if a change happens in a large or mid-cap company, they're going to have press releases, they're going to have investor presentations, they know the lingo, they're going to have IR, who can speak for them. And microcap, it just kind of happens. So you don't know what's going on, but you're like, okay, gross margins, we're 60% now, are trending up towards 70%, or maybe they were 40, gone to 50. And you're like, that's weird. Like, what is going on? So, I mean, that tells you something. It doesn't tell you everything, but, that might screen to you. Maybe they've paid down a lot of debt. It tends to, you see that. It tells you something, different. Their capital allocation strategy maybe is changing. Maybe their business strategy has changed. I mean, this is a million different things. I would say, I mean, the only way to do it, is, just start at A and go through Z and, read a lot of prior business, or investment books, business studies. So you see what's, worked in the past.
For sure.
You can pick up on that.
No, absolutely. And that's all great advice. I mean, you're right. And you know what? I talk about this with Mosh Swaydown all the time. And every investor that comes on here, they're, at the end of the day, you've been doing it long enough. It eventually becomes pattern recognition, right? Like, exactly where to go to, what you're seeing and all that. And, that's all very important to continue to put out in the universe for folks to realize is that, hey, there's a bunch of different investors that this is how they do it to build up that pattern recognition in order to find that potential, ideal investment, or
yeah. And I think, that's where you got to be passionate about it. I mean, it's got to be a real passion. Like, I mean, if you kind of fake it, you're not going to, maybe you fall in love with it, but either, you really like doing it or you don't. I mean, that's fine. I mean, you don't gotta like everything, but that's probably weird. But if you do, I mean, that will sustain you, because a lot of it, I mean, it's hours of just clicking and looking at stuff.
Yeah, and especially in microcap, it's a lot of weird.
Yeah,
it's a lot of weird shit. I'm gonna say a lot of weird shit for sure.
Yeah.
Sorry, I mean, I have a 3-year-old, so I'm used to just like spelling out curse words all the time. So, one part of your process that I really appreciate, that I think is something that I think everybody should really be paying attention, especially in microcaps, is when you're looking at a potential market or just, a basket of companies within the same sector, and really just diving deep into all of them and finding the anomalies. I think that's a really interesting way of doing things.
Yeah.
So I'd love to learn a little bit more about that research process, and then maybe examples of how certain ideas may have stood out to you when you've been doing that kind of research. So Andrew, you want to take that first, then we'll go to Nick, or Nick and then Andrew? Who wants to go first?
Yeah, I mean, again, I can start off then, Nick. Yeah,
Okay.
Again, and sort of dive into it. But yeah, I guess, I mean, Nick and I talk a lot, about the ideas that, he comes up with when he goes from A to Z. We talk about the ideas. Then, yeah, I don't know, there's a couple of times where literally like the hair stands up on the back of your neck. You're like, this sounds amazing. And some of the ideas that we've come up and we've spoken to other investors about, they literally say, I can't believe this exists. So we've had this recently. And it's just, there are some situations where, like Nick says, there's often the companies that we find, they're going through some kind of change. So like Nick was saying, the gross profit might be changing, or there's some change to the balance sheet or income statement that you spot, and you're trying to spot it really early, as early as you can before other people. And sometimes you're spotting it before the real change has kind of occurred. It's, you look through the company description, the annual reports of the previous years, and you realize some change has happened. The company's changed direction maybe 2 or 3 years ago, but it's just starting to then show through in the financials, and you start to see this kind of hockey stick or uptick in what's happening with that company. And then in the perfect case, that's accelerating. So the gross margin keeps going up, the profit that feeds through to the profitability, and the company is also growing. So you start to have a situation where you've got a stock that's a value stock trading at like some kind of ratio 6 or 7, which is already cheap anyway. But then it's got this growth that's maybe not visible yet, and then starts powering through. And then you're holding this growth stock at a PE of like 6 or 7 or better. And it just becomes very obvious very quickly that there's something that has happened to this company. Everybody starts to see it in the earnings multiples, which go to crazy levels. Sometimes they can dip down to 3 or 4 for a brief period of time before people realize something is definitely happening. And, whether it's like a frivolous lawsuit that's gone away or cash injection from the government, there's lots of different reasons why these things happen. You start to then, really see the value come, and then that obviously then impacts the price in, the stock. And you get these situations where something will double or triple in a period of 6 to 12 months when the thesis plays out. And then, you look back and you can see it then becomes obvious that's why that happened. There was this, it's almost like a special situation then sometimes, that something very unusual has just happened to this stock, and whether it's internal, that the business has changed, or an external factor, it's just great to see that kind of thesis come through. And then, there's just been a couple of times when Nick and I have talked about positions, and then, it's literally like hair standing up on the back of your neck kind of moment.
I hear that, especially in microcaps. Nick, your thoughts?
Yeah, I mean, to me, like when you go over and the more stocks you look at, the more patterns you recognize, but you also get a more of a sense of valuation of what's cheap and what's not. I mean, some things are absolutely cheap, like 4 or 5 times earnings, but you'll get a sense in this market, like, okay, this is cheap and this is cheaper, and two, cheapness is one of those things that's like, I'm a beholder. I have, a lot of friends and they'll recommend something and I agree that it's cheap, but it's not as cheap to me as other stuff. And, in value investing, there's a lot of different things that can be cheap, and it's got to fit in the context of, your portfolio and what you can understand. But the more you look at stocks in a market, the more like, okay, this one's cheap, this is cheaper, this is what I like, and it's really, it's a constant process of always comparing them, comparing this against that stock. So
for sure. And one last point too on this idea of of doing that comparative analysis within its peer group. It's one thing when you have a bunch of basket within there, but it also makes it easier when it's oligopic I won't say it is an oligop, but oligopic like you guys have put out a ton of research on RCI. What other adult type entertainment company is publicly traded out there? I can't think of one off the top of my head, especially in small and microcap. But like that's I can understand why you probably were looking deeper at that. I know for probably other reasons as well. But
yeah, Rick, I think it's a good example. You click through it, and especially pre-COVID, like you could see things going on in the income statement, and it really hadn't quite shown through. Like you could see their margins were improving a little bit. That's one where too, like you looked at. It wouldn't screen well, but when you kind of look at it, you see return on assets, especially return on tangible assets, are actually pretty good. At 27%. So you could see something was going there, and you could see like there's some kind of a mode or barrier to entry or whatever. And then when you do the research, like there's nobody out there who really explains that to you. Like there was nobody that told you about the barrier to entry because of regulation and licenses. There was no kind of like in a market, and this goes to like you could see it happening, but much before the market picked up, like the revenue per club was increasing. So you don't know, well, what's going on there. You're not sure, but you dig into it and you're like, okay, well, they've changed their strategy a little bit. They've gotten rid of the poor clubs. Now they have just the best clubs. And the capital allocation strategy, so all those things, like when you first come across it, you don't know, but if you looked at a lot of stocks, something sticks out and you're like, okay, this requires more investigation. But then, if you read, some of our the research on it, like none of that, like if you were investing in Apple or like Salesforce or something like that, like there would be analyst reports that would explain all of these things. But they don't exist, in something like Rick, because it's just, that you don't have Goldman Sachs sell side analyst research in it. So you got to put that together. And, a lot of times, the market disagrees with you, especially at first. And, because you're putting, a lot of things I think with stocks is they get, every stock, it's like a story that builds around it, and I think like with Rick, the story before was like these are dirty, seedy strip clubs, like what you would think in the 90s. Eric, the CEO, they just like to party, etc. And that's the story. But then you dig into it and you're like, well, no, wait, look at this. Like the returns are great. The capital allocation strategy is probably one of the best ones, I've seen, small or large. And they're doing these transformational things. So, that story, and it takes a long time, especially, Rick's a little bit bigger of a microcap for us, but to change that story. And I don't know, like there's an anchoring bias, I remember Buffett talking about this, like the price determines the story, right? The story doesn't determine the price, or, I guess Soros would call it like a reflexivity. But, Rick all of a sudden went up to 220, the story around the stock would suddenly change, right? If it's goes down to 40, the story would change, and those might be completely, who knows sometimes why prices do what they do. So, our job is to, figure out what that fair value is regardless of the price, just take the pitches we're given.
Of course, absolutely. And look, whatever your opinion is on the business itself, at the end of the day, actually me and Andrew were joking offline how, like, I've interviewed Eric since like 2011. I've been following the company back when it was called Rick's Cabaret, and for being a public company for as long as it has been. And he's been very uniquely suited to be able to answer these questions. I know a lot of, the folks that have been working with him over the years and have helped him as well. And, right. so he's had to really train himself in order to kind of answer those tough questions as well. But by the way, just want to make sure we're clear for full disclosure. Are you guys, do you guys have it in the fund, Rick's?
Yeah, we still own it.
Okay, good.
We've owned it for a while. We don't have any plans of selling it at the current price. And yeah.
Got it. Very cool. So I want to actually transition to something else that you guys were talking about, and that's the idea of, looking for value. I think everybody listening is always looking for value and something relatively cheap, or cheap in the eye of the beholder. And actually, you guys just, like I said, you just put out the Q3 2022 letter, and you talk about finding good value in banks in the U.S. As well as community banks. So, Andrew, can you tell us a little bit about what you've been seeing and why you brought this up in the letter?
Yeah, that's probably one of the situations where, we'd been looking in the US as the markets had climbed up, and then Southeast Asia looked relatively cheaper than as the markets have corrected. We've found some, better value in the US, but this is one of those situations where it's almost a special situation in that there's this ESIP program where, a huge amount of money is going to be put into these MDIs, minority depository institutions, and community development financial institutions to boost those economies and those communities. So I think it's a total of $9 billion is going in across a range of different organizations, and $2 billion set aside for the CDFIs, and $2 billion more for smaller ones. So it's a very unusual situation where the government's helping out these financial institutions and putting a lot of money into them. So they've invested a lot of preferred capital into them, which the banks can then leverage in the normal way. This is treated as tier one capital. They can leverage that capital and give out loans to the local communities and bring in deposits from the local communities and grow into bigger banks. And we don't know exactly what's going to ultimately happen with these banks, but they started off as very small institutions and could grow into being, over $1 billion in size. And the market caps of these, institutions are very small, so they're very interesting from the, from our investor perspective. But also, I kind of wanted to bring it to light and just talk about it a bit in the letter as well, just in terms of, it's a really interesting program. And I think the government's only really just started to kind of shout about it and talk about it, but it seems like a really good program just in general, forgetting about investments and all of that stuff, that this is just a good thing that's happening, I think. So I think I was wanted to talk about that in the letter. And I think it's something that a lot of people are going to start to hear about in the news and read about as it sort of comes to fruition, because this will be a multi-year program. It'll take years for it to kind of come to fruition and do all the the good stuff that I think it can do.
Absolutely. Nick, your thoughts on it as well?
Yeah. First off, I gotta give a little shout out to Dirt Cheap Stocks. He did a write up on it. And I don't think anybody's gonna know as much about that program as he does. Very sharp investor, and he knows him inside and out. So gotta give a shout out to that. But yeah, I think it's it's one of these unique situations where you have the possibility, because these stocks are small, of large movements. The business is changing rapidly, and I don't even think even after dirt cheap stocks did his write up. I mean, people kind of are still grasping. I think, for whatever reason, people moved on, discounted it, don't believe it. I mean, whatever it might be. But, there's more research you can do on them, and you're like, okay, like, wow, like if you look, comments I've heard and seen is, the return on assets was only like 33 bips or something. But the past doesn't matter. Like in these stocks, the past is just it. I'm not saying it's irrelevant. There's things you can learn from their past, such as their risk management, their culture, their mission, but the future is going to be dramatically different. And there's evidence out there of that. And it's also not even in their financial statements, but also in other programs or parts of resources they're getting. I mean, it's way different. I think, the program, it's a long-term program. I think the government is really trying hard to get capital into certain neighborhoods, both rural and urban, what they call banking deserts, where deposits, people put their money in a bank and then that bank makes the loans, in a different area. And that really has a detrimental effect on the growth and employment opportunities, and then, just the development of the community all around. So what the government's really trying to do is bring in stable capital. And so, when these banks make loans, that capital stays in there, and then also they can bring in capital from other places. So I think it's a well thought out program. I don't think the government's really, they're not advertising it. It's really, you can tell the way it's designed. They're thinking over like 30 years, right? Like they want this to happen. They don't want stupid loans to be made and then the banks fail and loans go bad. I mean, that'll just be completely counterproductive. But there's a 10-year that sets the preferred, and then even over time, they want to build these institutions up so they're solid. They bring a lot of people who may have been getting loans from pawn shops, at 30%, or payday lenders, charging a lot to transfer money. These banks now, they got Zelle, so you can go in there, you can take your money out of pretty much any ATM across the country now because they're part of these larger networks. And then also financial education. And importantly, I mean, making loans, in these communities, and also the banks too. And that's why I say, like, the past is way different. Like, you can't think about the past because everything's changed. And what they really want is they want these banks to have a stable core of earnings. So, like, say I make a loan in a neighborhood and that lender, or, has difficulties. If I don't have stable earnings, I got to be really hard on that lender. Now, if I have stable earnings and my ROA, say, is 1.5% or somewhere between 1.25% and 1.75%, I can work with that lender, right? Because I know I've got earnings coming over from my other good loans, or like from strong borrowers, say like for Citizens, that could be the Atlanta Hawks or this other housing project. And that's the long-term vision of this is, and then to make more and more loans over time and to reinvest that capital, as they grow it. So, yeah, I mean, I think it's a great opportunity. Again, I mean, full disclosure, obviously it's in our letter, so we do own it. And, I think it's an interesting case study of microcaps.
100%. Yeah. No, look, I've done a number of interviews with some folks like, Nate Tobick and quite a few guys that are very focused in banks and know way more than they probably forgot stuff that maybe I'm just learning. So, yeah. I think, I'll refer everybody to listen to this and do some follow-up research from everything that Fairlight's also putting out. And then also some of these, definitely I'll make sure if you guys send me that link for dirt cheap stocks that from, I know him from Vegas. He came to our conference.
No, he's a regular guy. Yeah, I know him well. He does.
I don't know if he wants me to say his name, so that's he goes like Dirt Cheap. But shout out to Dirt Cheap Stocks, and we'll make sure to get. I don't know if that link's public, but if it is, send it over. We'll put it in the show notes. Yeah. So now I want to get to the next topic that's also in the letter. Like I said, I want to try and cover everything. We got a lot to talk about still. And that has to do with the LDI pension crisis. You say in the letter that the events in the United Kingdom may point to what is in store for global markets for the remainder of the year. Everything that's been going on in the UK from this perspective has been covered quite a bit in the FinTwit community. So I think I'll go to our local gentleman on here right now, Andrew, who I'm assuming is from England as well, based on his accent. I don't want to presume anything, right? But I figure I'd give you the first crack at this and tell us what's going on here.
Yeah, no, you're right. I am, from England. So maybe that's why I was kind of, biased and put it into the letter. But I saw this evolving, the LDI pension crisis, over the last few weeks, and it kind of reminded me of some of the things that happened during the the global financial crisis. That is this the canary in the coal mine, or is this just a one-off event that's specific to the United Kingdom? And I just sort of dug into it and just wanted to make sure I understood it and we understood it. And just to kind of give you a bit of the background, that obviously rates are going up. People have been raising base rates, Fed fund rates been going up, but specifically in the UK. There was a change of leader, change of chancellor, and they issued this mini budget which had a lot of spending and didn't really have a lot of funding for the spending in the mini budget, and so that kind of spooked the markets, and the gilts, so the UK government bond rates spiked up even more, which is partly a function of that. They were going up anyway, which is kind of indicating, I think, that rates are going up even further. And then it just kind of highlighted, I think, maybe one of the cracks that can appear as you raise rates very quickly, which has happened, just recently. If you look at the charts, I think it's one of the fastest periods of rate increases, not the fastest. And you start to think, well, what's going to break in the financial markets? Because you don't know every position an institution holds, or their hedging, and the complexities of the financial markets, all the different interrelationships. And this highlighted something that originally I wasn't aware of, that the way the pension schemes for defined benefit schemes are hedged and managed these days, and the way they do it is they have a sort of a mixture of different assets. So some risky assets like PE funds, and obviously they have stocks and a mixture of bonds, but they're also performing this hedging, which is liability driven investment hedging, where they essentially want, which makes sense, that their fixed term liabilities that they have many years in the future, if those move up or down, they want their assets to move up or down as well. So in an increasing rate environment like we've just had, rapidly increasing rates, the future fixed liabilities, the value of those came down. So in theory, the pension funds don't need as many assets now. So they put on hedges originally way back over the last years, over the last 10, 15 years, that meant that their assets went down, but which is fine in itself. But some of those positions were derivatives based. So when the value of those went down, you had margin calls. So suddenly the pension fund has to deliver some cash to meet the fact that this asset now has gone down in value, which is hedging off something 10, 20 years in the future. And as that happened, some of these pension funds have had to force sell assets, which, again, sounds very scarily like the global financial crisis. And they've had to sell some of their PE investments, stocks, and it's affected a variety of different instruments. And it just struck me, is this, like I was saying, that one of the first things that's going to break in the market, or is it just a one-off situation? And there are maybe some parallels in the US. There are similar kinds of schemes in the US, these LDI schemes, which kind of pooled versions of this approach. It just kind of struck me that it's maybe something to watch, that as rates increase, effectively, the Fed is going to have to increase rates until something breaks. It has to try and control inflation, and it's anybody's guess. We don't know any more than anybody else what's going to happen to inflation in the next 6, 12 months, 2 years, 3 years. Some people think it's going to come back down. Maybe it comes down to a level of 6, 7% or 4%. And that's kind of the big unknown in the market now. And I think this is kind of, we've tracked things like this just for our own kind of education. And I hope, the kind of increase in the interest rate environment maybe helps some of our stocks actually in terms of our own portfolio, that, we've got positions where the cash flows are more near term. They're not as growth stocks in the sense of no cash flows now, so they do have cash flows, but they're growing. Whereas the old meme stocks and growth stocks, where all of the cash flows are far in the future, they might get impacted much more by increasing rates. So hopefully we can kind of be shielded from some of this in terms of things we invest in. But yeah, it was just something I wanted to call out, just in terms of keeping an eye on what might happen in the future in the markets.
Absolutely. Using that information and kind of this global outlook and everything that's going on right now, from, war in Ukraine to, inflation, what maybe this whole, who knows if this is just an isolated example of, maybe things that might not just happen in the US, but maybe in other parts of the global community. I mean, how you kind of answered this already, but I mean, how does it change your outlook when you're looking at a potential investment right now? Like, do you, like, maybe previously you were thinking maybe 1 to 3 years. Now is the time to look at some of these. I say, maybe we should look 3 to 5 because there might be a little bit more hair coming. Who wants to take that first? Andrew?
Yeah, maybe I start off, then Nick can kind of dive into the details. I guess it affects it kind of at the margin. We're very much bottom up, so we don't start off with this macro picture and then build up based on. But it does kind of obviously influence the way you think about things, and so it obviously makes you think that that near-term cash flows are good. So we always thought that anyway. So it probably doesn't affect in terms of anything you look at from that. But I guess the other aspect to it might be geopolitical as well. So in Southeast Asia, we've been careful as to which markets we kind of go into there as well, in terms of how we think about the region. And Nick's done some great analysis, kind of almost ending up doing much more kind of macro analysis in Southeast Asia and China, just in terms of what's going on over there and why you find some of these cheap situations and things that we might want to avoid. Certain countries that might not want to go into, like we've kind of ended up being more in Singapore and Hong Kong, for example. So it kind of at the edges and the margin kind of does impact what you're doing, but I think the driver is always from the bottom up. But then it's always good to keep an eye when things are changing this dramatically, what is potentially going to happen in the near future.
Very good. Nick?
Yeah, boy, there's a million things you can think about on this. We're bottoms up, right? So one question we get a lot is like, oh, do you guys like have a theme of like, oh, I'm going to invest in this country and then this sector, and then you go find the stock? No, that's like completely opposite of what we do. It's like, give us 1,000, 10,000 stocks, let's shake out, let's see what comes up. And then if that still sticks, and the overall macro environment is still, we don't think it's going to destroy us, we'll invest. I don't know. I would say for me, when I look at a lot of these short-term things, like I listen to like a lot of podcasts where macro forecasters and macro guys talking, and I don't want to be rude to them, but I've never heard people that are wrong so often. Like, a lot of these guys, and I like listening to them because they're super smart people, but they'll be like, oh, I was wrong 6 months ago. It's like, well, yeah, you got this theory and they walk through it and there's like 7 steps. And each one of those things has to be right for their theory to be right. And you're like, okay, even if it's like 70% odds that's right, like go through 10 things, like your odds of being wrong are really high. So I think it's really hard to predict those things. The framework I use a lot is like, I know Nassim Taleb talks about like fooled by randomness, and he talks, a recent podcast I listened to him, he's like, we're all worried today about losing our liberty, losing our freedom. Why are we worried about that? Because we have it, right? Like, and that makes us cognizant of like, it can go away. And like, these are the situations where things can go bad. But if you look at the trend has been, things have gotten extremely better over the last 2,000 years, or probably even over all of human history. And so I think, for me, like everything has, is a trade-off in life, but I think you go out 30, 40, 50 years, the human race, will be better off. Unless, of course, maybe we drop nukes on each other, but my attitude is like, who gives a shit then? Like, you might as well be investing in stocks. Like, what? It doesn't matter if you hold dollar bills or gold bars or, Microsoft stock. If we nuke each other, it's all off the table. So in that sense, like, you're going to go through the ups and downs of business cycles, geopolitical cycles. But the trend seems to be, upwards. And if you look at the longer term trends, you stick that out, you don't be that 6 foot tall guy who drowns in a river that's 5 foot average depth on average. You'll make it to the other end and you'll be much wealthier in 20 years. So I don't know. I mean, I probably spend more time thinking about and listening about macroeconomics than I should. I'd probably be just better off, like when I go for a hike, to turn those podcasts off and listen to the birds. I think, it would be when I get to be 60 or 70, I'm like, yeah, I should have just, enjoyed that hike a lot more than thinking about what's going to happen in Ukraine, or, is, the British economy going to tank? I mean, whatever, the thing of the day might be. Yeah, I mean, it's not our specialty. I would say we think about it. What we think about a lot is, like, if we go to a market, how are their laws? Do they have laws that protect, minority shareholder rights, or do they not? An instance of a stock, in Singapore, a company had an investment in Vietnam. We haven't invested in this company, and I'm not going to disclose the name, but it owned several other investments. One of them was a company in Vietnam. The founder tried to steal that company. Now, if you had invested directly in Vietnam, you'd been shit out of luck. That you wouldn't have got that back. But the Singapore courts said, no, you got to give this company back to the rightful owners. And so those shareholders who own that company ended up holding the holding company, ended up retaining ownership. So there's things like that. And then I've seen other things, like in Singapore, where another company has tried to buy a company in Africa, but it was money losing. So the Singapore Stock Exchange said, you can't buy this company. It's not in minority shareholders' interests. So that's kind of, the more of the things, we look for. You tend to find those strong shareholder rights in markets that have strong influence from the British, where the British had helped set up court systems. And that's, if I'm going to invest in, like, a emerging market, it tends to be best to do it through Singapore or Hong Kong, or US companies. I think, a lot of companies are developing, and I think in, 10, 15 years, things will change that. But I mean, that's, more important is this long-term trends than short-term fluctuations.
Absolutely. That was great, man. I wanted to let you just cook. That was good. That was you're doing your thing right there.
Well, yeah. I mean, I think about it because, like, I don't know. I personally, like, I think, like, here's an example, like Doomberg. Like, I love Doomberg's analysis. These guys are super smart, but I had to quote following them on Twitter. I mean, I'm just like, you guys are making me nuts. Like, I love the emails I get to my inbox, and it's super smart. But if you read them every day on Twitter, you're like, dude, I might as well go back and, like, just shoot myself. Like, this world's, and they have good points, good analysis, but I think, and some of those things will happen, but it won't be the end of the world, right? Humans can adapt. We can survive things. I know sometimes as Americans, I think, like, our generations, a lot of us haven't gone through, like, what generations before, like, World War II and the Civil War before that, and, like, the Great Depression, like, but I think it's there. Like, if bad things happen, we can still, like, adapt, and we can still, it's not going to ruin us.
For sure.
So, yeah.
No, finish your thought there. Sorry.
Yeah. So, I mean, I think it's good to think about geopolitical things, but I'll be honest, like, I don't think long-term, like, it's good for your financial health.
For sure. And look, you're 100% right. Especially, I mean, going back to even my first interview on here, I think every microcap investor will say, look, it's good to know what's going on from a macro perspective, but at the end of the day, like, do your best to try and tune out the noise. Like, it's good to know. I'm not here to tell you, like, don't, watch the news, or, if you get your news from Twitter, kind of seeing, some of your favorites there. But at the end of the day, especially if you're going to be in microcaps, there's a lot more stuff you really need to dig into if you're going to be a successful microcap investor. And one more point too, talking about how there is just a lot of noise right now. One of the things that I've been enjoying is, one, always getting those differential insights based on maybe certain people have the same premise of what they're seeing, but then relating that to their own individual industry. Okay, well, how does this affect us? Right. That's been super interesting, and kind of getting a better idea of how, like, especially microcaps dealing with, on the healthcare side, cannabis, all these different things, because they are very, very interconnected from that one singular premise of what's going on in the world. So in that sense, it's good to have an understanding of what's going on. But at the end of the day, how does it relate to the things that you're most interested in, right?
Yeah, exactly.
And then taking advantage.
Yeah, I mean, I definitely think it's worthwhile, and it's worth thinking about risk. I mean, we think about a lot of risk, like in an individual stock. I mean, we think about all the time, like what could go wrong, how could this go bad. But at the end of the day, you still got to function, and you still got to make decisions. So, I think, I mean, it's one of the negative, like with everything. Like I said earlier, there's a trade-off, right? And with Twitter, for example, you can get in touch with people you would have never got in touch with before. You can find great information. You can find great things. But, if you don't go on that upper right corner and click that sort by like latest tweets instead of using their algorithm, like it can kind of mess with your mind, right? And
for sure,
even without doing that, like it can mess with your mind because whatever reason, negative news tends to spread fast. It tends to be what sticks to people's memory. So, and right now, like, I mean, and what I notice on Twitter too, things go through cycles. Like, so it seems like a 2-year cycle. Like this is the popular thing, and like right now, like I heard the term doom porn. Like doom porn is really popular now, and that'll be popular for 2 years, and then it'll go on to like, I don't know what the next thing will be. It was, before it was crypto craze, and then the next thing will be the next thing. So you it's good to know those things. And they're, like I said, like, Doomberg, I mean, those guys are smart. They do excellent pieces, but, when you just read just the emails, I feel like I have a better understanding of the world instead of just taking all the negative out of Twitter. Like that really messes with your vision or your understanding or, your conception of how the world is. I mean, if you look at Twitter, you think everybody would be out in the streets punching each other in the face and spitting on each other. But the reality is, like,
it's definitely good to get on Twitter for a little bit. As my colleague Caitlin Cook likes to say, hashtag get outside.
Yeah,
that's for sure.
So, yeah, I mean, I think overall, I mean, the world's going to be a better place in 10 years, and we want to be part of that, right? We want to underwrite that
for sure. Andrew, give us your thoughts here. It's time. Let's let you cook a little bit on this.
Yeah, no, I was going to say very similar thoughts to Nick, really. But yeah, I probably read Twitter far too much. But I think, like he says, that there is a really exciting, interesting community within FinTwit, and maybe it's like a subset of FinTwit that I think you have to be optimistic about the future of the world. And like if you're investing in microcap stocks and you look at these individual kind of small companies and what they're doing, there's a lot of exciting technology out there. I'm very excited by a lot of the stuff that's happening in machine learning and AI. Although again, there's lots of doom systems by taking over the world. But I think you just have to look at these small companies, and you have to be optimistic when you invest in them and think, that the world is going to, continue on and be, a better place in the future. Like, again, Buffett says in his letters that, the US is much more wealthy now, but per capita than it was before, and I think it's true across the world. Generally speaking, there are ups and downs and volatility, but generally we're heading in the right direction. But yeah, the world is a scary place now. But if you look at snapshot in time, then the world was scary at lots of other points in time as well. But you have to kind of somehow, like Nick says, tune out that noise and be optimistic.
For sure. One kind of change.
Can I jump in?
Yeah, please. Yeah.
I mean, I think trends, like you talk about geopolitical trends. I like to think about longer term trends. Like, I mean, something I've thought about a lot is, where can I invest in 10 years? And I think, like a market that will be very interesting is going to be like India. I mean, and, can we invest in India? I know right now China is very negative in the US, but if you actually go through and you look at stuff they're doing there, I think the longer term trend, like I'm not invested there really right now, but in 10 or 20 years, like, I mean, these markets I think are going to provide great opportunity, and even Southeast Asia too. And go back, 20 years ago, and you had the Asian financial crisis. I mean, they were not prepared for it. So far, the emerging markets seem to be handling, the rise in interest rates as well as many developed markets. So, but you don't, that doesn't stick in your mind. You don't hear that in the news. And I think at some point, you got to think where you want to invest in 10 years from now, and be thinking about that and be prepared for it. So.
Not to get in the weeds a little bit, you say you're looking in Southeast Asia. Are you looking at India at all? I mean, I only ask because, I had an amazing conversation with Gautam Bade a couple of weeks ago, and how he's starting an India-focused fund here in the U.S. And, he was making some incredibly compelling points as to why, U.S. investors should look there. And sometimes I feel like it gets completely overlooked. Folks go to Hong Kong, Singapore, Vietnam, other places around it. But, have you guys been looking there at all? Because you do look globally.
Yeah, I've looked through India, but this was probably 3 years ago. I looked through, not every stock in India, but a lot. Well, every small cap stock in India. I think you had the Mumbai Stock Exchange and the other one, Mumbai, I think also. And but then there's problems with trading in there, and you'd have to set up a special fund. And there, we had plenty of opportunities, so we didn't go there. But I could conceive of that, sometime in the next 10 years, you'd want to set up and be able to invest there. And we would, hopefully have infrastructure in place and resources where we would be making investments there. Right now, I find, again, it goes to, if I can make an investment and gain exposure to India through Singapore, I'm a little bit happier doing that. And, I haven't had a lack of ideas where wanted to go there. But I think absolutely, whether you go India, Southeast Asia, they have demographic trends on their side. Don't underestimate the power of demographics. And, they have a lot of young, educated people, and they're getting more educated, which means, they're going to be the STEM, students creating the engineering products. And long term, I think that whole region is, there's going to be great things happening there. And I think it'd be foolish to not be like, man, the world's going to be a nuclear war, so I don't want to go invest there. I'm just going to stick with U.S. stocks. I don't know. To me, I don't make sense. But
absolutely. Andrew, you have a take?
Yeah, no, again, just reiterating what Nick was saying, that, I think that's somewhere that we'd look at in the future, that, setting up a new structure, or you're looking at it. We've kind of, as Nick said, we were lucky that we found a lot of, good ideas in Southeast Asia. So we kind of pivoted to there at the same time that we were looking at India. So we kind of didn't need to go through those extra steps. But certainly in the future, I think, it's that kind of, they have a great legal system, and STEM students, and the demographics are there. So it's got to be an area you're going to look towards in the future. And I think, again, as Nick says, in the future, the world could look very different in 10, 20, 30 years in terms of, China and India, I think.
Absolutely.
Yeah. And I think you'll see a lot of companies, listing, there'll be, the capital markets will get deeper, wider, the legal structure will improve. So, I don't know. I think, again, this goes to, what we talked about at the beginning, Buffett had advantages, and people always wish they could have went back time and been Buffett. But man, I got advantages where we can invest in Southeast Asia or India, or, Buffett couldn't do those when he was starting out. So, take the good with the bad. And I think that's part of the good.
No, look, for our upcoming virtual event, I'm doing my first ever Stock Pitch World Cup based on this idea, because of the fact that, look, there's a lot of, especially really more so in microcap, folks are looking everywhere, right? Yeah. Europe, Australia, London, Israel, Asia, everywhere. So, Africa, South America. I want to make sure I named all the continents. There's no companies incorporated on Antarctica yet. So we don't have that right now, but yeah. So look, we've covered a lot. I think we're pretty much there. So I think this is a good place to kind of close out our full conversation. And listen, I know we could probably go for another 2 hours. I say that probably in every conversation, but we could easily go for another 2 hours because there's so much to talk about. But, from your guys' perspective, let's say there's some new investors that are looking at this, maybe even some new microcap investors listening. And, what advice would you have for them in this current environment that we're existing in right now, and how they can best take advantage? So, Andrew, I'll start with you, and then Nick, you can close this out.
It's a very good question. And I think, again, maybe as echoes of the global financial crisis, that there's a lot of negativity and pessimism, and it won't feel like it now, but these are some fantastic times to invest in stocks. And like Nick does go from A through to Z, you probably find in this market, and as the market continues on, if it carries on correcting, that you won't have to go that far through A to Z because there's some good positions out there. But yeah, don't listen to the noise and the negativity. You're just like 2008, 2009, and other times in the past, this could be one of the better times to invest in. And when everything was exuberant last year and the year before, that wasn't a good time to invest. So yeah, don't listen to that noise. You have to kind of be contrarian, I think.
Nick?
Yeah, I mean, I think it's a lot of the same thing. I always feel like, when you're new to investing, and I definitely had this, I guess, call it syndrome or whatever, you're like, oh man, like I wish I could have been investing during that time, right? Like I wish I could have been doing OTC stocks in the 90s and the early 2000s. I wish I could have been investing in 2008 or March 2020. Like, I mean, you always feel like the best times have already passed. But I think now is a great time to be starting. Next year will be a great time. The year after that, there's plenty of opportunities out there. They're different than they were 5-10 years ago, and they'll be different in 5 or 10 years from now. But I would say, it's a great time. You can make great returns now. I mean, nuclear bombs might drop, but I wouldn't worry about that. You're not going to change that. And the world will get through the crisis coming up, and, just get out there and start looking for stocks. And if you find something cheap, I'd be buying it. I wouldn't worry about, if interest rates are going to go up another 1.5% and then come back down. I mean, it's just, you don't know, who knows, but it's a great time. I know there's cheap stocks out there. And I think, these opportunities will be around for years to come. I always thought like, oh man, like the markets are going to get so efficient, like all this is going to go away. I think things will change, but I think markets will also get bigger. I mean, capital markets will expand. And I do think, we're moving into an era of, there could be a little bit of capital constraint, as populations age in the Western world, and, different countries put in different social programs, which will require a lot of capital. So, the future will be different. Stocks you invest in will be different from stuff that's been successful in the past, but study the past, and be optimistic about the future. And today is a great time to be starting. No doubt about it.
That's a great place to end it right there. So with that, Nick, Andrew, where can everybody go and find more information about Fairlight Capital, as well as to follow you on social media? So how about this, Andrew, you give us the social media of where people can follow us, and then Nick, where people can go and find you guys online. So Andrew, you first.
Yeah, so we're primarily on Twitter, I guess, is where we're most active. So yeah, at Fairlight_cap. And just search for, Fairlight as well, and you'll see our old tweets. So yeah, and read what we've been writing on there.
Very good. And Nick, what's the company's website?
Yeah, fairlightcapital.com. You can get up there. We put some research on there. Disclosure, we do put stuff up there, and typically we own it. But when I write these things, what I try to do is I try to write it so there's ideas. Like if you read Rick, it's about Rick, but there's ideas in there that will transfer to other stocks. And same thing with all these things. I try to, it's not just about that stock. It's about different models and that you can transfer to other things. And follow us, visit our website. If you ever got questions, feel free to reach out either on Twitter or email.
Very, very cool. All right, dudes. Well, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next conversation.
All right. Thanks a lot, Robert. Have a great day.
Thanks, guys.
Yeah.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.